Okay, Howard. I'm so glad to have you back.
And I'm glad to
So
be here.
we last talked like 10 months ago, April last year. So when the pandemic had just broken out and the market was collapsing, and you recommended us not to be too defensive because the world is less risky compared to the end of 2019.
Right.
So it was a really nice advice for me because I actually bought some stocks. But the problem is I spent just small portion of my budget because I wanted to diversify my timing of the purchase. And I waited for another decline, but the market rallied in a straight line. So my question is, could you explain why this happened and how this bull market is different from the previous ones? And do you agree with me? The market is a risky place again.
It's a lot of questions all at once, but I'll try to remember all of the parts. First of all, let me just say that in buying a little, but not enough. First of all, there's only one kind of investment where you can say I didn't buy enough.
Yeah.
That's a successful investment, right? So you should be happy that you were successful. Most people didn't buy. Lots of famous, well-known investors didn't buy. So you bought a little. And it was very hard to, they never send out a message saying, now's the time to buy. And most people, when the market is collapsing like that, they don't buy at all. So you did well. Now, why did it happen? Well, you know why it happened. It happened because the Fed and the Treasury were hyperactive. And in March, they came out with very strong programs that would, number one, support the economy. Number two, support people who lost incomes, and provoke a recovery. Number three, they reduced the interest rate, the base interest rate, the Fed funds rate to zero. And that is very, very influential, because it makes buying and investing more attractive because it lowers the cost, buying a car on time or leasing an apartment or building a factory. And it reduces prospective returns. So it makes people, you can't keep your money in cash. You can't keep your money in treasury bills. You have to move out the risk curve, take more risk. So people become risk tolerant. And the other thing is all the debt crises that I've been involved in the past always had a panic attached in the capital markets, and the capital markets would close, which meant that if you had debt outstanding that you had to refinance, you couldn't do it and you would default. And that's why the three crises that we've been associated with have produced extremely good buying opportunity in debt. But this time, by reducing the interest rate to zero, it made people go out and invest. And when those people provide financing, the capital market stays open. Right. So we didn't have a big string of defaults. The default rate never got as high as predicted, and it quickly came down. So for all these reasons, the Fed engineered a recovery of the economy, the markets, and the capital market through its actions. And they used the playbook from the global financial crisis, which took months to develop, but they did it in weeks or days and much larger.
Yeah.
So that's the explanation. And it's certainly true that the market ran ahead of the economy. The real question is are stocks risky?
Yeah.
Now some are, but as for the whole market, it's I'm sure you read my last memo. It's very hard to make a judgment about the market if you can't prove that the big tech stocks are overvalued. And I think it's hard. First of all, you have to be an expert, which I'm not. But you can't just say, oh, that stock has a PE ratio of 30, so it's too high. Because that ignores the fundamentals of the stock. These are wonderful companies. Maybe they're worth those valuations. I think the stock market is, as you say, the prices have run ahead of the economy. It's not cheap. It may not even be fair. It's on the high side, but I don't necessarily think it's at a risky stage. I may be wrong, but normally in past when we're at a high in the stock market, it's because we're at a high in the economy, and the economy's been going up for several years.
Right.
Now, stock market prices look very full, but we have a big economic recovery ahead of us. So I hope that answers your question.
Let me ask about the value, the growth investing, as you written in your recent memo. So you wrote that value investors should not refrain from investing in growth stocks, right? And growth companies, and should not think value investing and growth investing mutually exclusive. So could you elaborate your thoughts for the Korean readers?
The essence of value investing is getting good value for your money. Now, value investing over the years has kind of been standardized to mean investing in things where there's limited uncertainty, high predictability. That means the future is easy to foresee, and low valuations. So the future is not very dynamic, but the stock is inexpensive. So in other words, not great, but also not expensive. And the question is, why can't a value investor think bigger? And why can't a value investor think about fast-growing companies? So, if you think about fast-growing companies, now you are talking about companies with a dynamic future, but the future is always uncertain. So clearly, growth investing can't be as based on fixed, precise numbers to the same extent. You have to accept more uncertainty, and you have to pay more because the future is promising. So it's harder to do. Excuse me, it's harder to do right, but it shouldn't necessarily be off limits. Now, what I do think though is, so that's the principle. The principle is that even the value investor should be open to companies that are fast growing and have a dynamic future and are high priced based on the numbers, but high PEs. But the realistic side is you can only do those things safely and dependably if you're an expert. So I don't think that your readers should try to do high-tech investing on their own, because you need an expertise. You have to spend a lot of time doing it. You can't do it in your part-time. And when you get to a point in the market like this, where there's been a substantial up move, and there's a lot of optimism incorporated in stock prices, the market tends to treat all high-tech companies as if they're going to be successful. We know that a small percentage will be very successful. So it's risky to invest in high growth companies without expertise at a time when they're in favor. That's the bottom line.
So you recommend investors to use like ETFs or that kind of instrument?
No, because ETFs don't help either, because ETFs are passive vehicles. Nobody's making an active selection. Nobody's studying the companies, and nobody's saying, oh, this one is overpriced, this one is underpriced. They just buy what's on the list.
Mhm.
So I think you have to be in actively managed mutual funds.
Oh, okay.
I think is the best answer.
So mutual
But
funds who specialize in the
in
growth
whatever
investing.
in whatever it is you want to do, but certainly technology. But of
Mhm.
course, I think that's right. I think now it would help if you could find one with a good record, and I
Mhm.
don't know which ones have good records. But the mere fact that it's a mutual fund, and the mere fact that it's professionally managed and charges a fee doesn't mean that the people running it have skill. So I think what you have to do is you have to find you have to look at the record. And by the way, you have to, in particular, don't look at the record last year because tech
Mhm.
did great. And you
Mhm.
didn't have to have any discernment last year to do well.
Mhm.
Look at a tech mutual fund at a period when tech was out of favor.
Mhm.
And that's really, I always think that the test of a money manager, the test of an investor is how did he do or how did she do when her style of investing was out of favor.
My next question is about the timing, actually. So from your memo, I'm convinced by you and Andrew's argument that we should invest and hold compounding great
Yes.
growth companies for a long period of time. But if you look at the valuation today, as you mentioned already, it's quite frightening for us to start investing in those stocks. For example, Tesla's PE ratio is like 1,300 or something, and nobody can say it's fairly valued with full confidence. So doesn't this situation remind you of the market crash of the Nifty 50 stocks in 1970s?
Well, you just played a trick because you used Tesla as an example and then
Mhm.
you generalized it to the market.
Okay.
Tesla is not a typical example. Tesla
Mhm.
is a great extreme.
Mhm.
Uh, Again, I mean, a lot of very smart people are short Tesla stock because
Mhm.
but a lot of smart people own it, and they're the ones who've made the money so
Mhm.
far. So I think Tesla is a great example of a company where nobody knows anything about the future of Tesla
Mhm.
in terms of knowing. They have guesses, they have hunches,
Mhm.
but nobody knows anything.
Mhm.
And people should not, individuals should not play that. If you're a novice investor or not an expert investor, and you make a bet on Tesla, either long or short,
Mhm.
it's like going to the casino
Yeah.
and putting your money on red.
Right.
Nobody knows.
Mhm.
That's not intelligent investing. That's
Mhm.
gambling, in
Yeah.
my opinion. So the secret to investing is to invest in good companies
Mhm.
as long as the prices aren't crazy
Mhm.
and hold them for a
Mhm.
long time. If you could find companies, if the earnings will grow at 7% a year,
Mhm.
then the price will probably grow at 7% a year,
Mhm.
and your money will double every 10 years.
Mhm.
And if you start doing it at 20, if you
Mhm.
put in $100 at age 20 and
Mhm.
you live to 80,
Mhm.
it'll double when you turn 30, 40, 50, 60, 70, 80. It'll double 6 times.
Mhm.
It'll go from 100 to 200, 400, 800, 1600, 3200, $6,400.
Mhm.
Every dollar will turn into $64.
Mhm.
That's all you have to do. That's the magic of compounding.
So in Korea, at least in Korea, to 2020 will be remembered as a year of retail investors because their direct investment into the stock market has increased exponentially, as opposed to capital outflows from equity mutual funds managed by active money managers. Do you think this phenomenon will last?
Well, uh, mean, I don't know anything more about the future than anybody else, but certainly the trend toward passive investing, like ETFs, has been very strong. The ETFs, many of them have been in the right place. Many of them emphasized Amazon and Apple and Microsoft, the big top stocks that were the big winners. And to some extent, this is a self-fulfilling prophecy, because self-reinforcing process. Because if you have a bunch of ETFs, if the biggest ETFs have big allocations to the biggest tech stocks, and they go up, then they attract more money. Then they automatically invest more in those tech stocks, and that makes the price go even further.
Yeah.
So the stocks, if the ETFs are receiving a disproportionate amount of the cash flow into the market, then the stocks that they feature will do better than the market,
right?
As long as it happens. I believe, and I wrote a memo about 3 years ago, maybe 4 years ago, called Investing Without People. And what I said in there is what I believe. Eventually, if Apple, Amazon, and Microsoft keep going up more than the market, and more than they deserve to go up based on their fundamentals, just because of an excess of demand, eventually they'll reach a point where they're overvalued. And when they become overvalued, at some point, something else should start to do better. Because it'll reach a point where it's overvalued relative to the other stocks. And somebody, even though active investing is out of favor now, somebody will say, you know what, that's too high. I'm going to sell out of Apple, Amazon, and Microsoft. I'm going to buy General Motors, Ford, and U.S. Steel. And if that person does it visibly and it successfully and it makes money, then everybody will rush to the other side of the boat. I mean, ETFs and other forms of passive investing have encouraged investment in one sector or one group of stocks. And so they've outperformed because they got more demand. But I just believe it can't go on forever.
But, in Korea, some retail investors say it's unfair that only institutions can sell short because it's hard for retail investors to borrow stocks. So some regulators are reforming the system to make it easier for retail investors to sell short. So do you agree that the system should be reformed, or
no?
What's your advice for retail investors who want to have some exposure to short positions?
Yeah, but you know what? Look, there are some funds in America which are short funds, and they don't have a good record. It's very, and these are people who do shorting for a living, and shorting is so much more complicated than being long. If you own a stock, you own a stock. You own a share in that business. But if you go short, number one, you bet against the business. But number two, it's highly technical. You have to worry about borrowing and interest and squeezes like the GameStop. And the other thing is this. If you buy a stock for $10, all you can lose is $10. If you buy a short a stock at $10, you can lose infinity. And amateurs should not do it. By the way, I've been in the business 51 years. I've never been short a stock. I've never had a short. It is not part of the mainstream of investing. I can promise you.
It's very hard to find alpha in the traditional asset classes like stocks and bonds because the market has become extremely efficient, right?
Right.
But it's very hard for retail investors like us to have exposure to alternative asset classes like Oaktree because it's expensive, right? So any advice for the retail investors who want to have some exposure to alternative assets?
Well, I mean, I believe that there will be ways for individual investors to get exposure coming in the future years, because you know, the institutional investor today in America certainly is de-emphasizing stocks and bonds because they don't offer enough return, and they're going into the alternative asset classes.
Right.
And in America, most people's retirement accounts are what are called 401ks. You put money aside pre-tax, and the employer makes a contribution also, and you invest it yourself. And 401ks don't have exposure to alternative assets. So I think the government's going to want to find a way to give it to them. So I think there will be all mutual funds for alternative investments in the future. But in the meantime, if you really want to have exposure, what you could do is you could buy the stocks of the companies that do alternative investing. You know, several of them are public, and you could buy the stocks. KKR, Apollo, Blackstone, Ares. We used to be public, but but we were bought by Brookfield. You could buy a Brookfield stock. Brookfield invests in real estate, private equity, infrastructure, renewable energy. So, I think that would be the best way.
Right. My last question is about Bitcoin.
Yeah.
So, recent hike in Bitcoin price after Tesla announced it bought $1.5 billion worth of Bitcoin made me think I can't be dismissive to cryptocurrencies anymore. So, has your stance toward Bitcoin changed as well?
When it first became well known, which was 2017, I believe, I came out and I was very dismissive of it, because it doesn't have intrinsic value. But there are a lot of things that people want and value highly, which have no intrinsic value. How about a painting or a diamond, or a bar of gold? So, what I've been studying lately is people make the case for Bitcoin is made on the basis of supply and demand. That the supply is fixed by the software at 21.5 million Bitcoin, and there are already 18.5 or 19 million outstanding, so it can't expand much, unlike the dollar, which can be printed in infinite amounts. And the demand is growing because more people are interested in it.
Yeah.
But it's a little circular because people want it because it's going up in price. It's going up because people want it. Well, that's circular. Is there an independent reason why people want it? Well, the argument is that it's very useful to be able to trade instantaneously. You can trade 24 hours. Do business 24 hours a day, 7 days a week. Banks, the bank's closed. You can't send a wire. This you can do anytime. You have it. It's confidential. Nobody knows about your holdings but you. The government can't know, etc. Nobody can steal it from you. It's better than an emerging market currency. So there are all these arguments about why people want it, and if the supply grows and the demand doesn't grow, then economics tells us the price goes up.
Right.
But is that enough? Is that a sufficient reason? That's the question. But certainly, look, as I say, I was dismissive in 2017, and I can't claim to be proved right yet. Right? I was probably 5,000 when I said that, and now it's 50. So the people who bought it at 5,000 were so far they look right. All I'm saying is that my as I said in the memo, my initial response was a knee-jerk reaction without information, and that's not a good way to behave. So now 3-4 years ago I was willing to comment. Now I've learned how much I don't know. So you shouldn't talk about things you don't know about.
Okay. So, but at least you try to learn more about it. Right?
Yes.
Yeah. All right. Okay. Thank you, Howard. I learned a
Always
lot.
enjoy it.
So thank you so much for your insight.
Good. My pleasure. Thank you.